China just pulled off something the markets never thought possible. It borrowed in dollars at the same rates the United States. Investors rushed in with over $65 billion in bids. Days later, Nvidia halted all chip exports to China under Trump's latest ban. Yet Beijing didn't flinch. Within a week, Huawei released a fully domestic processor, no US parts, no foreign dependence, and sold out instantly. The symbolism couldn't be clearer. Both pillars of American dominance, the dollar and the microchip, are losing their edge. According to Bloomberg, the bulk of demand came from sovereign wealth funds, insurers, and central banks, the same type of buyers that once financed Washington's debt auctions. The Financial Times added that China's 3-year dollar bond priced equal to US notes, and its 5-year version carried only a slight premium. For the first time ever, Beijing's cost to borrow in dollars matched America's. While US Treasury auctions struggled to find buyers, China's issue was oversubscribed. But why now? The US Treasury's own numbers hinted at the pressure point. In early November, Washington was trying to refinance about $125 billion in new long-term debt. Primary dealers demanded fatter yields, bid coverage fell, and auctions lagged. The irony was unmistakable. The world's reserve currency issuer was now paying investors a premium to lend. With federal debt near $39 trillion and annual interest payments above $1 trillion more than the Pentagon's budget, confidence was slipping. Beijing, on the other hand, was moving in the opposite direction. China's public debt remains below 80% of GDP, and inflation is barely 0.3%, according to its National Bureau of Statistics. That stability allows Beijing to sell bonds aggressively without losing investor trust. In October, the Finance Ministry announced a domestic purchase of 20 billion yuan in sovereign bonds to ease long-term yields. The People's Bank of China followed up with liquidity injections and repo operations to smooth short-term rates. A perfectly coordinated fiscal monetary play that Washington's divided Congress can only envy. Meanwhile, China's quiet retreat from US Treasuries has accelerated. Reuters reported that its holdings dropped to $756 billion, the lowest since 2009. Japan and the UK picked up some of the slack, but much of that was custodial. Chinese banks have been cutting exposure. The US still depends on foreign investors for nearly a third of its treasury demand, and every step China takes backforces America's borrowing costs higher. Bloomberg Intelligence estimated that each $100 billion reduction in foreign holdings raises U.S. interest rates by about 12 basis points. Small in isolation, massive when applied to $28 trillion of marketable debt. By late October, U.S. 10-year yields hit 4.95%, the highest in 17 years, while China's equivalent slid below 2.2%. The yield gap that once made U.S. bonds irresistible had vanished. Global investors were now treating Chinese paper as equally safe. Analysts at the Financial Times traced this shift back to 2022, when Washington froze $300 billion in Russian reserves. Since then, central banks from Brazil to Saudi Arabia have been diversifying. Gold purchases hit records, and allocations to Chinese bonds rose sharply. As economist Zoltan Pozsar put it, if you fear sanctions, you build your own plumbing. And that's exactly what Beijing has done. The People's Bank of China has now expanded its network of currency swap lines to over $580 billion across 40 countries, a financial lifeline that bypasses the dollar entirely. In 2025, Argentina, Pakistan, and Indonesia all tapped those lines to stabilize their currencies. Every transaction settled outside the U.S. banking system. Then, in November, Beijing went one step further. It issued a $2 billion bond in Paris, under its new Panda Euro program. More than half the buyers were European institutions, a clear sign that confidence in yuan-linked assets is growing, even under U.S. diplomatic pressure. Across the Pacific, U.S. corporations were running into trouble. S&P Global warned that corporate defaults in 2025 had already surpassed pandemic-era highs. Rising rates meant refinancing pain for companies addicted to cheap credit. The tech sector was hit hardest. In response, Huawei and Bessent rolled out new AI accelerators built entirely from domestic supply chains. Bloomberg Technology reported that Huawei's Ascend 910B chips now match Nvidia's previous generation A100s in power efficiency, a milestone that once seemed years away. Beijing's industry ministry quickly followed up with another $40 billion in semiconductor funding through state banks and provincial programs. Even the energy grid reflected the trend. China's State Grid Corporation logged a 9.2% jump in industrial electricity use, showing how AI training and manufacturing were ramping up despite export controls. Energy subsidies kept prices around 6 US cents per kilowatt hour, compared to 17 cents in America, giving Chinese factories a decisive edge in power-hungry industries. Every dollar China chooses not to spend hits Washington hard, in the billions. The battleground is no longer just trade, it's energy, production costs, and the ability to scale. Cheap power and patient financing give Chinese companies a huge advantage, letting them expand while US firms stall. The story plays out in AI as well. OpenAI revealed that its planned global data center expansion could cost as much as $5 trillion over the next decade. Analysts at Morgan Stanley warned that, under current cash flows, the plan simply doesn't add up. Treasury yields near 5% make borrowing for such ambitious projects nearly impossible. Bloomberg even reported that OpenAI approached US authorities seeking government-backed credit, similar to what defense contractors receive, a signal that Silicon Valley's AI boom is bumping against the limits of public financing. Meanwhile, Chinese AI hubs in Guangdong and Chengdu have been able to secure ultra-low-interest loans from state-owned banks at rates below 2%. The National Development and Reform Commission linked these funds to infrastructure projects, from modernizing power grids to capturing waste heat. In this environment, cheap capital isn't just money. It's a strategic weapon. Labor markets reflect the contrast. In the US, October alone saw 153,000 job cuts, the worst monthly loss since the pandemic. Manufacturing payrolls fell for the fourth month in a row. Reuters noted that roughly half of the losses hit interest rate-sensitive sectors like construction and tech. Credit tightens, projects freeze, jobs vanish. China, in contrast, saw its unemployment rate dip to 5%, with industrial output climbing 5.2% year-on-year. Export growth in electric vehicles and batteries, up 70% since January, drives yuan inflows that offset any losses from lower treasury purchases. China's trade surplus tells its own story. Bloomberg estimates that in the 12 months through September, the surplus reached $1.3 trillion. Each dollar creates a choice: funnel it into US debt or circulate it through Chinese banks abroad. Increasingly, Beijing is choosing the latter, lowering US demand for new treasury issues and driving up Washington's cost of capital. UBS strategist Paul Donovan told the Financial Times, "Every bond China doesn't buy is a bond someone else has to absorb at a higher yield." Markets priced that absence immediately. By mid-November, foreign participation in treasury auctions had dropped to 12%, the lowest since 2011. Banks that must buy the remaining debt are sitting on record inventories. Bloomberg Markets called it a slow-motion buyer strike. The dollar's global dominance is slipping. Bloomberg reports its share of global reserves has fallen to 58%, the lowest in 25 years, while the euro rises to 21%, and IMF's SDRs hover around 5%. IMF analyst Saran Arsenal describes it as slow erosion, not a sudden collapse. But even gradual erosion can reshape the global financial landscape. Chinese policymakers are exploiting the moment. Pilot programs now allow foreign issuers to list yuan-denominated bonds in Hong Kong under simplified rules, creating a mirror of the Eurobond markets London hosted decades ago. Scale will follow once confidence grows. At an October Beijing forum, former SAFE official Guantano explained the strategy. The goal isn't to replace the dollar overnight, but to ensure China never depends on it. This marks a strategic pivot from hoarding U.S. assets to building independent alternatives. Meanwhile, U.S. data centers are hitting power constraints. The Energy Information Administration projects AI-related electricity use to rise from 17 terawatt-hours in 2023 to over 150 by 2030. Grid upgrades are falling behind, and construction costs have surged 30% since 2021. Without access to cheap energy or financing, the AI boom risks turning into a crisis of cost. China, by contrast, has surplus capacity from hydroelectric and coal power. Bloomberg NEF estimates that idle industrial infrastructure could support AI clusters worth $200 billion GDP by 2027. Factories once making solar panels are now cooling and powering massive computing hubs. Policy in Washington is fragmented. Congress debates a debt stabilization act meant to cap interest spending at 3% of GDP. But analysts warn market forces could override any ceiling. According to the Wall Street Journal, some foreign policy advisors privately fear Beijing could manipulate bond issuance timing to coincide with U.S. auctions, draining liquidity without firing a shot. This dynamic became clear on November 8. China issued $4 billion in Hong Kong bonds, and demand closed the books in just hours. The next day, the U.S. Treasury sold $42 billion in 10-year notes at the highest yield since 2007. With foreign participation at historic lows, markets noticed. Economists at Nura called it a test of the dollar's credibility. Investors demanded a premium, not due to default risk, but because U.S. policy uncertainty makes forecasting nearly impossible. By mid-November, the yuan stayed steady near 7.1 per dollar, defying expectations of decline. Capital controls and robust trade surpluses have anchored confidence. Beijing has, in effect, neutralized the dollar as a weapon without abandoning it. Treasury Secretary Scott Bessent now faces a paradox. To defend the dollar, he must sell more of it, feeding into a market China no longer relies on. As global investors shift toward Chinese debt, Washington is paying a premium just to maintain credibility. If China no longer needs U.S. dollars, who really controls the system?